Okay, let's talk about the US economy because right now it is sending some seriously mixed signals. It's like it has a split personality. On one hand, you see these massive cracks forming, real signs of distress. But on the other, well, it looks like a full-blown party.
And that brings us right to the heart of the mystery we're unpacking today. How can both of these things be true at the same time? It really is like an economic detective story, and we're going to follow the clues to see if we can figure out what is actually going on.
And this slide just lays it out so perfectly. Look at this contrast. In one corner, you have the real economy, actual companies making and selling things, and they are struggling. Bankruptcies are spiking. But in the other corner, you have the financial markets, and it is absolute euphoria. Trading is off the charts. These two pictures just don't seem to belong in the same frame.
All right, so let's start digging for some answers. Our first clue takes us right into the heart of the corporate world. And honestly, what we're seeing points to some pretty significant stress.
9. Just let that number sink in for a second. That's how many large U.S. companies filed for bankruptcy in just 1 week.
And just so we're clear, we're not talking about small mom-and-pop shops here. We're talking about major players, companies with liabilities over $50 million. So when you see a trend like this rising tide of failure among big companies, it's a huge red flag that something is fundamentally off.
Now, this chart really puts it all into perspective. Our current average is 6. The only times it's been higher were back during the pandemic chaos and in the fallout from the huge financial crises of 2001 and 2008. We are getting uncomfortably close to that 2009 peak of 9. So the main takeaway here is pretty stark. This isn't just a blip. It's a historically high level of corporate distress.
Okay, so clue number 1 points to some serious trouble brewing. Now, let's move on to our second clue. You'd think it would point in the same direction, right? Well, not exactly. In fact, it does the complete opposite.
$1.03 trillion. Trillion with a T. That is the brand new record for the average value of stocks traded in the U.S. every single day. That record was just set in January. The scale of that number is just, wow, hard to even wrap your head around. And it's not just the enormous number, it's the speed of the whole thing. That's kind of mind-blowing. A 50% jump in trading value in just 1 year. The amount of money flying around the market hasn't just grown, it has absolutely exploded. And this isn't some freak one-time event. Look at this timeline. Before 2025, trading more than 15 billion shares in a single day was incredibly rare. It only happened 3 times, ever. But in the last 13 months, it's happened every single month. The market isn't just hot. It's running at a pace we've literally never seen before, and it's sustained. So, we've got corporate pain on one side and market euphoria on the other. As if that wasn't confusing enough, let's throw our third clue into the mix, and this one comes from the wild world of cryptocurrency. Okay, first, a real quick primer here. A stablecoin is basically a type of crypto that tries to keep its value stable, usually by pegging it one-to-one with something like the US dollar. They're super important for how money moves around in the crypto world. Right, so check this out. On February 11th, a crypto tracking service called Whale Alert picked up this massive transaction, over $160 million worth of a stablecoin called USDT, moving from its creator to a big exchange. But then, on the exact same day, just a few minutes later, another alert. This time, $50 million worth of a different stablecoin, USDC, was burned. So what on earth does that mean?
Okay, so this is the crucial part. These are 2 giant, completely opposite actions happening at pretty much the same time. That USDT transaction, that's seen as printing new money, injecting fresh cash, fresh liquidity into the system. But the USDC transaction, that's the exact opposite. Burning tokens means they are permanently destroyed, taken out of circulation forever. That pulls liquidity out of the market. It's just wildly conflicting.
All right, let's just take a step back for a second and try to make sense of all this. We've got corporate distress, we've got market mania, and we've got total crypto confusion. So what's the big picture here? So let's lay out our clues on the detective board. Clue number 1. The real economy is clearly under some serious pressure, with bankruptcies hitting alarming levels. Clue number 2. The financial markets are having the party of a lifetime, shattering records left and right. And clue number 3. The crypto world is sending completely contradictory signals about money supply. You know, when you put it all together, there's one conclusion that's pretty hard to ignore. There is a massive disconnect here. It's almost like two parallel economies are running at the same time. One is the real economy, where big companies are struggling, and the other is the financial economy, which is just supercharged with cash and seems totally indifferent to the cracks forming everywhere else.
And that brings us to the final and maybe trillion-dollar question. Which story is the right one? Are the bankruptcies just isolated problems in an economy that's actually pretty resilient? Or are the financial markets in some kind of speculative bubble completely detached from reality? The clues we have don't give us an easy answer, but they sure leave us with a fascinating and critical puzzle to think about.